Welcome to the Opening Bell Report.
Usually when we sit down to crack open a stack of reports, we're looking at, Silicon Valley. We're talking about AI. We're talking about chips, software eating the world. That's the dominant narrative right now.
It is. The market has been absolutely, obsessed with tech. If it doesn't involve a GPU, most investors just aren't even looking at it.
Exactly. But today we are pivoting hard. We are looking at something that feels a lot more old school. We are talking about pulling metal out of the ground.
Right.
But here's the thing. We found an anomaly. We're looking at this massive outlier operating kind of quietly in the background, a silver giant that has just posted a metric that, frankly, it makes some of those high-flying tech stocks look a little sluggish.
It really is a fascinating case study. It's almost a counter-narrative trade. While everyone is looking left at the digital revolution, there is a very physical revolution happening on the right.
So let's introduce the subject. We are unpacking an analysis report on Hecla Mining. Ticker symbol is HHLE. And before you zone out thinking about mining trucks and piles of dirt, I need to drop the headline stat from this report on you. This isn't a typo. We are looking at 400% earnings per share growth.
That is a staggering number. In a mature industry like precious metals, you usually fight tooth and nail for, 5 or 10% growth?
Yeah.
400% is explosive.
400%? And
Yeah.
The market is reacting exactly how you'd expect, or maybe it's finally catching up. The stock just ripped 5% in a single day, hit a brand new 52-week high, closing at $26.54.
Oh yeah, it's definitely caught the attention of the street. The volume is up, interest is up, it's on the radar now.
So that's our mission today. We need to figure out, is this the start of a massive silver supercycle like the bulls are claiming? Or is this a bubble that's, ready to burst? We're going to parse this analysis report to understand the fundamentals behind the hype. Because look, I'm going to be honest with you. When I see 400% growth on a mining stock, my scam radar goes off.
Skepticism is healthy.
Yeah.
In fact, it's necessary.
It feels like a trap. So let's deconstruct this explosion. We have to look at the financials because a stock price is just a sentiment indicator until you look at the balance sheet. So let's unpack this earnings per share, this EPS shift. Because 400% sounds great, but percentages can be, they can be incredibly misleading.
They absolutely can be, yeah.
If I find a penny on the sidewalk today and tomorrow I find a nickel, my income has gone up 500%, but I'm still broke and I can't buy a coffee with percentages. So is this just base effect math, or is there real money here?
That is the crucial question. And to be fair to your skepticism, there is a base effect at play here. The report makes it very clear. If we look at the comparison provided, last year, Hecla's earnings per share was sitting at what the analysis calls a measly 6 cents.
6 cents. Okay, so basically flat. They were buying lunch, maybe.
Barely profitable.
Yeah.
But right now, that figure sits at 30 cents.
Okay. So from 6 cents to 30 cents, that is the 400%.
Exactly.
See, and this is where I get stuck. 30 cents isn't, it's not exactly setting the world on fire, is it? Why is the market freaking out over 30 cents?
Because you aren't just looking at the absolute number. You're looking at the mechanics of how they got there. And this brings us to a concept that is absolutely critical for understanding mining stocks. And the report really leans heavily on this. It's called operating leverage.
Operating leverage. Okay, break that down for us.
Think about the business of mining. You have these massive fixed costs. You have to pay for the diesel to run the trucks, the electricity for the mills, the labor for the miners, the insurance, the permits. Right. Those costs are huge, and they are largely fixed. Whether you pull out an ounce of silver that sells for $20 or $30, it costs roughly the same amount of money to get it out of the ground.
Okay, right. The trick doesn't care what the spot price of silver is. It just needs gas.
Precisely. So let's say it costs Hecla $20 to mine an ounce of silver. If silver is selling at $21, they make $1 of profit.
Razor thin margin.
Razor thin.
Yeah.
But if the price of silver goes to $25, just a modest increase in the commodity price, their costs are still $20. Now they're making $5 of profit.
So the commodity price went up, maybe 20%, but their profit went up 500%.
Boom. That is operating leverage. And that is exactly what we are seeing in this report. The jump from 6 cents to 30 cents signals that Hecla has crossed that threshold where their fixed costs are covered, and now every incremental dollar in the price of silver is flowing straight to the bottom line.
So the engine is just running significantly hotter.
Way hotter than it was 12 months ago.
It's like a coiled spring. Once you get past that break-even point, the profits just explode.
And the report uses the word evolved to describe this shift. It's not just about the silver price. It's about efficiency. They've gone from burning cash, which, let's be honest, is the default state for a lot of miners,
right,
to generating positive free cash flow.
Let's stick a pin in that because free cash flow is a term that gets thrown around a lot. Why is that specifically important here? Why isn't revenue enough? I see revenue is up 31% to $1.2 billion. That sounds pretty good.
Revenue is vanity. Cash flow is sanity. Revenue just tells you how much stuff you sold. It doesn't tell you if you made any money doing it. In mining, it is very easy to have high revenue and still go bankrupt because your capital expenditures, your CapEx, are so high.
You mean buying new drills, reinforcing tunnels?
All of it. Building new tailings ponds, you're constantly spending.
It's a money pit.
It can be. But when the report says Hecla has pivoted to positive free cash flow, it means they have paid for all of that. The operations, the new equipment, the maintenance, and there is still actual cash left over in the bank account at the end of the day.
Which means they can start diluting shareholders?
Exactly. They stop issuing new shares to pay the light bill. They can start paying dividends, they can buy back stock, or they can fund their own exploration without going into debt. It changes the entire valuation model of the company. It's a game changer.
Okay, so the turnaround is real, the engine is working, but now I have to play the role of the grumpy value investor again because I'm looking at the valuation section of this report, and there's a number here that just makes my eyes water.
I think I know which number you're looking at.
The PE ratio, the price to earnings ratio. The bear case in the report highlights that Hecla is trading at a PE of 87. 87.
It is objectively steep.
Steep. It's mountainous. I mean, usually you look for a PE of like 15 in this sector, maybe 20 if people are excited. 87 is what you pay for a tech company that's, doubling every 6 months. Why on earth would a rational investor pay 87 times earnings for a silver miner?
It's a valid shock response.
Yeah.
If you just ran a stock screener for value, Hecla would trigger every red flag you have. But this is where you have to look past the algorithm and look at the context. The report argues that the market isn't just paying for current earnings.
So they're paying for future growth?
Partly, but primarily they are paying for something else. Something that has become incredibly scarce in the last few years.
What's that?
Safety.
Safety. In mining, I thought we just established that mining is a capital-intensive money pit. How is that safe?
Not operational safety, geopolitical safety. The report calls it the secret sauce of Hecla's valuation. You have to look at where the metal is coming from.
Okay, let's zoom out to the map. Where does most of the world's silver come from?
Historically, the giants are in South America. The report specifically highlights Peru and Mexico. These are incredibly resource-rich nations. I mean, the geology is fantastic.
But the politics.
The politics are complicated and getting more complicated by the day.
Right. I've seen the headlines. Strikes, blockades, that kind of thing.
It's more than just strikes. In Peru and Mexico right now, if you are a foreign mining company, you are facing massive headwinds. You have communities blocking access roads for weeks at a time. You have uncertainty about permits being revoked. You have governments discussing nationalization.
Oh, wow.
Or just drastically raising royalties.
So you might own the mine on paper, but good luck getting the silver out of the country.
Exactly. You are fighting the government and the local population just to operate. Now compare that to Hecla. Where are their primary assets?
The report says Idaho and Quebec.
The United States and Canada.
Yeah.
North America.
Okay, I see where this is going.
The argument here is that Hecla commands a massive jurisdictional premium. Think of it like real estate. It's the best analogy.
Okay, hit me with it.
Imagine two identical houses. Same square footage, same granite countertops, same pool. One house is in a conflict zone where the property laws change every week and there are riots down the street. The other house is in a boring, stable suburb with a strict HOA but excellent police protection.
The house in the suburb costs 10 times more.
Exactly. Even though the utility of the house, the shelter it provides, is identical. Yeah. You aren't paying for the bricks, you are paying for the peace of mind that nobody is going to come take the bricks away from you.
That makes so much sense. So that PE of 87, that's the Manhattan price tag.
It's the Manhattan price tag. Investors are looking at the global landscape wars, trade disputes, populism, and they are saying, I want exposure to silver because I think the price is going up. But I cannot stomach the risk of waking up to find my mine in Mexico has been shut down by a cartel or a government decree.
So they pile into Hecla.
They pile into Hecla. It's a flight to quality. And in the mining world, quality means a boring legal system where contracts are actually enforced.
So the high price isn't necessarily a sign of a bubble. It's a sign that the market is accurately pricing in the risk of not owning Hecla compared to its peers. You're paying for the insurance policy.
That is the bullish thesis. And honestly, it holds water. If we enter a true silver bull market, the companies that can actually deliver the metal without interruption are going to be the ones that win, regardless of how high their labor costs are in Idaho compared to Peru.
I love that Manhattan real estate framing. It really clarifies why the numbers look broken if you don't have the context. Okay, so we have the fundamental explosion with the earnings, the operating leverage, we have the geopolitical moat with the location, but now we have to talk about the when.
The timing.
The timing, because even if I buy the best house on the best block, if I buy it at the absolute peak of the market bubble, I'm still going to lose money in the short term. And the report dives into the technical analysis. This is where the rubber meets the road for anyone thinking about actually making a move.
Right, because fundamentals tell you what to buy, but technicals tell you when to buy it.
And the report brings up the RSI, the Relative Strength Index. Now, I know our listeners are smart, but let's go a little deeper than just the definition. We know RSI measures momentum, but what is it telling us about the psychology of the traders right now?
Well, the report puts the current RSI at 75. In technical terms, anything above 70 is considered overbought.
Overbought. It sounds like a warning label.
It is a warning label, but you have to interpret it correctly. An RSI of 75 tells us that there has been a panic, but a panic to the upside.
FOMO, fear of missing out.
Pure FOMO. Buyers have been rushing in so fast, probably chasing that 400% earnings headline, that they have pushed the price up faster than is sustainable in the very short term. It means the rubber band is stretched to its limit.
So if I buy right now at $26.54, I'm basically buying when the rubber band is fully stretched.
You are buying at the point of maximum tension, and the analysis in the report suggests that because of this high RSI, we shouldn't be surprised to see a pullback. It predicts a potential slide back down to the $24 range.
Which is interesting because sometimes when people hear pullback, they panic. They think, oh no, the run is over, sell everything, the trend is dead.
And that is the amateur mistake. The report is very clear here. It does not view a drop to $24 as a trend reversal. It views it as a cooling off.
A pit stop.
Exactly. When a stock goes parabolic, you have traders who bought in early, maybe back when the EPS was 6 cents, who are looking at this vertical line on the chart and saying, I've made a lot of money fast, I'm going to cash out some chips. That selling pressure causes the dip.
So the dip is actually healthy. It shakes out the weak hands.
It's incredibly healthy. You want to see the stock retest lower levels to build a floor. And the report frames this potential dip to $24, not as a crash, but as a golden opportunity.
Load the boat, I believe was the phrase they used.
It was. And that speaks to the conviction behind the analysis. If you believe in the fundamental thesis that operating leverage is kicking in and the North American safety premium is real, then you should be hoping for that dip. You want that RSI to cool down from 75 to maybe 50 so you can enter at a better price point.
It's a second chance. It's the market forgiving you for missing the first jump.
That's a great way to put it.
So the verdict from the report is pretty unambiguous here. It views Hecla as a breakout stock with massive momentum. The pullback is technical noise, but the trend is fundamental signal.
It is. It's a complete picture, and it really highlights why you can't just look at one metric. If you only looked at the PE of 87, you'd run away screaming. If you only looked at the RSI of 75, you'd short the stock. But when you layer them, earnings growth plus geopolitical safety plus technical timing, you see the logic.
It really is a fascinating puzzle. You know, we started this whole thing talking about how everyone is obsessed with AI and tech. And here we are, 15 minutes later, realizing that digging rocks out of the ground in Idaho involves just as much nuance, strategy, and economic leverage as a software startup.
It really does. And frankly, in a world that feels increasingly unstable, the value of real things produced in safe places might just be the most modern investment thesis there is.
That is a powerful thought. So let's bring this all home. Let's do a quick recap of the 3 pillars we've uncovered for Hecla Mining, ticker HL.
Sure. Pillar 1, the financials. We have the operating leverage kicking in. Costs are fixed, silver prices are up, and that leads to that massive 400% earnings growth and a shift to positive free cash flow. The business is self-sustaining now.
Pillar 2, the geopolitics. We have the safety premium. While competitors in Peru and Mexico are facing strikes and political chaos, Hecla is operating in the boring, stable jurisdictions of the US and Canada. Investors are paying that high PE of 87 for the privilege of safety.
And pillar 3, the technicals. The stock is currently overbought with an RSI of 75. So the smart money is waiting for a cool down, maybe to that $24 range, to load the boat for the next leg up.
It's a compelling case. It challenges the idea that you need to be in the flashiest, newest sector to find growth. Sometimes the growth is just sitting there in the ground waiting to be dug up efficiently.
Absolutely.
Which leads us to a final provocative thought. I want to leave with you, the listener. We've spent a lot of time justifying that PE ratio, but I want you to really chew on this. In a global economy where supply chains are fracturing, where tariffs are flying, and where political stability is becoming a luxury item, is peace of mind actually expensive?
Or is it the most valuable commodity of all?
That is the question. When the world gets crazy, maybe the most aggressive move you can make is to buy the thing that lets you sleep at night.
Safety is never priced too high when you really need it.
Something to think about. the next time you look at your portfolio? Are you investing for maximum theoretical return in a dangerous world? Or are you investing for certainty? Sometimes you have to pay up for the pillow.
Well said.
That's it for this deep dive into Hecla mining. We hope this helped you parse the signal from the noise, check the numbers, look at the charts, and as always, stay curious. We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.